I'm Ashton Addison from Blockwest Capital for InvestmentPitch Media and the Crypto Coin Show. And today on Blockchain Interviews with Max Galash, the CEO of CoinChange. Max, welcome to the show and thanks for taking the time.
Thanks for having me, Ashton.
You're very welcome. I'm excited to dive into the world of DeFi yields with you, Max. I would love for you to kick off our conversation with a little bit on what is CoinChange, how are you bringing these yield solutions into the cryptocurrency industry, and then we can dive into the details.
CoinChange is a crypto wealth management platform. So in a simple phrase, we bring in Wall Street to the main street. So what Robinhood did for stocks, putting everybody in charge of their own portfolio and palm of their hand, we're doing for the wealth management. So we are the professionals who mitigate risk, identify opportunities, manage the assets, and utilizing the new ecosystem of DeFi to generate yield for the customer deposits.
Love it. And I would love to elaborate on that a little bit. I know there's a lot of these basic assets that I've seen can get pretty good yields in crypto so far. Stablecoins getting over 10%, Bitcoin and Ethereum still 5 to 7% yields, it seems. Much better than the traditional banking system and Wall Street. I would love to hear a little bit more about some of the financial products that your team is already offering out of the gate.
So right now we have two main accounts. Both of them are stable coins. So our system is based. Let's revert a little bit to the foundation of the platform. So our system right now is built on three pillars. One of them is data, then it's modals, then it's execution. It's all proprietary framework that we've built in-house. It's our own IP. And it happened to be that 2 years back when we started CoinChange, we identified DeFi as a growing ecosystem. And they had about $20 million of the TVL cross-platform. Ethereum was the only one who was actually enabling any of that activity to happen. So we thought it might be this abstract layer that's designed to incentivize liquidity providers and provide yield on the liquidity, we thought would be a future of finance. We thought it might get a market share eventually, and we put our effort and bet and dollars and time towards building a platform that we thought would be sustainable long term. So I think right now in today's world, a lot of people provide yield through lending, right? Securitized lending, replication of the assets of the clients, pretty much getting it from the retail people and sending it to the institutional trading desks. Right, and getting a slice of that. We are very different in our yield because we have this proprietary platform that we designed and built in the last couple of years. We can play in DeFi and be yield generator ourselves. We're not actually providing your liquidity to a counterparty, a centralized counterparty who's trading on that balance sheet. What we do, we have a data component that analyzes real-time and historical data through multiple protocols, through multiple pools, and identifies what's the best ROI for the liquidity at a certain point of time. It takes into the account the fees, the slippage, the gas fee, to move that liquidity from one place to the other, cross-chain, cross-protocols, cross-pools. All those protocols and pools are pre-selected. So we curate, we have a risk department that analyzes the counterparty risk. Because right now, this is the only risk that we face with the stable coins. Because the impermanent loss is very, very minimal. The stable coins, they're not one-to-one with the dollar as well. There's a market for that, it fluctuates. Some stable coins are more risky than the others. But at the end of the day, the impermanent loss is very, very minimal compared to the Bitcoin or any other volatile asset. So our risk department, for the most part, centers its effort around counterparty risk, not the market risk, not the impermanent loss risk, but the counterparty risk. So selecting the pools that can be drained, checking the flash loans, checking the audits, checking the technology behind it, and furthermore, it's not only humans, right, who do that. We have the models that monitor that liquidity that's been deployed to the pool because we have a real-time data we can analyze. So anything abnormal that happens in that pool with the liquidity or with the actions, we can pull the liquidity out of that, right, and remove it to the other pool that either less risky or pays better. So we went with a very, very low risk strategies right now, and with a largest APY we can get with that low risk. So currently we generate about 12.5% APY on stablecoin accounts, and you can deploy USDT and USDC to that. So the yield, everybody understands right now, comes from yield farm. Okay, so there is no staking right now involved. There is no lending involved. And we're working on that right now. We're working on the Bitcoin account that's going to hit the market, and the complexity around that, as well as I mentioned, is impermanent loss. So you need to hedge on the fly. So your strategy has to take a position either in the derivative market or the lending market like Aave against that asset to make sure that when you get your liquidity token back and exchange it for the asset, it's the same value of the asset that you get, not in the dollar value, but in the in-kind value. Okay. So that's a complex algorithm that has to be real time, and it's a bit of a machine learning on top of that because you have to analyze the data and adjust towards the position. So that complexity has been worked on for the last 4 months, and we're testing it internally right now. And Bitcoin account comes to market probably in a month and a half. Mm-hmm. So that's a data that's very important. So everything on the platform is built on data, real-time historical data. Models, this is where the quants come in, and they take that data and build mathematical model on top of it. Because DeFi is beautiful because all this abstract layer has the same rules for everybody. Equity markets, they're less transparent. Forex markets, they're less transparent. Blockchain brings transparency and efficiency because everybody sees the mathematical formulas that govern certain protocols like Aave, Uniswap, PancakeSwap, Compound, and so forth, right? So everybody can play by the same rules. So what it means, if you have a good, clean data, right, you can build a nice, clean model and can still work and earn, providing your liquidity to real time, right, and adjusting the liquidity. So us as a small shop, we're only 50 people right now and 15 people at the DeFi department. We can still compete and earn and be successful in this domain because there's no big banks, right? So nobody big yet came to market in DeFi. It's growing. People are buying Uniswap tokens. They're staking, but no algorithmic liquidity provisioning yet happening at scale. So let's say JP Morgan hits the market, trillions of dollars. Likely the payouts, the ROI on our liquidity will dry down a little bit, but it'll happen to everybody. So the less efficient people will get squeezed out. The more efficient people will stay in the market. So definitely right now the competition is not high. I mean, we've been there for 2 years, and the platform actually, I think, well developed. So I haven't seen really much, let's say, under the hood of Swissborg. So this is a similar business that does liquidity provisioning and has an oracle of their own in Europe. Our main market is US, and we do have certain regulation as per we roll ladders to the states explaining our business model. It's called ladders authorization. We do FinCEN and FinTrack. We use analysis. We use Jumio. We use KYC 2020. We have compliance processes. We have Fireblocks with their own policies on top of liquidity management. So there's a lot of things and processes we embedded into the business to be compliant. We knew that I mean, if you understand, the original bet was that the industry is going to grow. So if the industry is going to grow, it's going to become big, right? If it becomes big, there is a big risk towards consumers and towards businesses who participate. So what does it mean? To mitigate the risk, government has to step in to regulate, right? To enable real insurance, right? To enable real processes and real certifications, right? So government always wants to protect the consumer, right? At the end of the day, I mean, whatever they do, they're slow, they're not efficient, they're not smart about blockchain, they don't know the market, but they act in a good faith. They might not act properly, right, in a lot of occasions, but it's always a good intent to make sure that the consumers are protected. So we knew that we thought we betted on the market was going to get big. So we actually, from the day zero, we embedded the culture of compliance and regulation in the business, right? It slows you down, right, compared to, let's say, fully decentralized layer 3 protocols, right, that has no KYC, no requirements, fully decentralized, no reporting, because compliance is not only KYC. Compliance is, you have to make sure that client actually earns on what he puts in the system, right? And you have to prove it transaction by transaction. So the government steps in and they say, show us the transaction for Ashton. He deposited $1 million. Was he actually earning that you guys showed to him on your platform? How can we reassure that his assets were deployed where you showed they're deployed at that risk? So we have to track all that on the database layer, and then we have to fit it into the accounting system and financial system and restructure, right, and refilter that information to show to the regulators when they come. So we do already practice that internally. Mm-hmm. And that comes with the culture of compliance, culture of regulation, but that kind of holds you down a little bit on the innovation. So there's always a fine line. How much of the regulation compliance you want to put on top of your product team, on top of your science team, right? So we try to have that fine line. And overall, I think going to fine line in life, there's always a balance, right? Family work balance, health and work balance. So we try to reassure that we're balanced in our portfolios, balanced in our approach, and balanced in our strategies.
Definitely, and thank you for all that detail on the system. It sounds like you have the compliance there, you have the platform really laid out. Obviously, spending the last few years already building out the foundation to make sure that the groundwork has been laid properly. I think is very important. And at the end of the day, for users that are just getting into DeFi and they have Bitcoin and Ethereum and they're trying to find ways to get a good yield. Or stable coins, keeping it low risk, that at the end of the day, they don't really have to understand that you've protected, all they have to know is like you're mitigating risks for them, right? You mentioned flash pools and all of these different techniques you're using to make sure that you're mitigating risks. But at the end of the day, people see USD Tether, I can get a good yield, I'll put my funds in with CoinChange and trust that system.
Ashton, to your point, so 100% to the point, like as an example, right? So last Sunday, we got a deposit of $250,000 into the platform, right? So we followed up with the client. So we try to make it very personal. So wealth management has to be personalized, right? So we follow up with our clients and we say, hey man, how did you find about us? Tell us a little more about yourself. Let's get on the call. So we have the full team working on that, customer success team. So that person came back to us. He said, I'm a client of Celsius. So everybody, a lot of people know Celsius in the crypto world, $25 billion balance. But he said, listen, they do loans, right? And I trust them, but I came across you guys. It's something interesting. I was fascinated by DeFi. I always wanted to get impact to that small industry that's growing right now and becoming larger. But I try to do it myself. I went inside, I started reading, started plugging in my MetaMask, and trying to fit the liquidity, and it took so much time, it took so much effort, and I wasn't sure if I'm doing the right thing. So I want to trust the professionals who do it day in, day out, who make sure that everything is protected, that the risk is managed, that the security is there. So I trust you with my funds to manage it properly and impact that world of DeFi. Because again, we have higher yields right now. To go back to the DeFi and the ecosystem and the business model, the way that we work, our yield right now is only capped by the best yield we can find on the best protocol. So our worst yield is the best yield of the best protocol we're connected to, okay? Because we work cross-protocol and cross the pools, right? So as far as we mitigate and manage the counterparty risk, choosing the proper large pools to play in that has multiple liquidity providers, that has a sophisticated security on their own, then we can get best yield of the best protocol we're connected to. So definitely people are looking for higher yield along with the security, right? So, and a lot of people diversify. So the example of that client.
Definitely. That's a great story and I love to hear it. And I want to you mentioned a little bit about this, but I want to just look forward because DeFi is continuing to grow so quickly, and I know CoinChange is working on more products. I would love to hear about the near-term goals between now and the end of this year, moving into DeFi in 2022. What are the main things that CoinChange is looking to bring out into the market?
So right now, our product that if you deposit stable coins, it's more like a fixed income product per se. So actually every day you get dollars to your account. So it's not a portfolio product. You realize gains every day. So pretty much you deposit $100 and there's a few cents taken into your account. So it's a daily interest, a daily yield, and it's compounded and there is no limit and there is no lockup. Okay. So the product is stablecoin strategy. It works on the stablecoin of USDC and USDT and actually compounds and realizes gains every day. So we compare it internally to a fixed income, let's say, right? Because the money comes in every day to your account at a certain point. The other product that we're working on right now is a more complex product that's called more of the mutual fund product or more of a portfolio product. So because when you end up with a certain token, let's say as an example, just as an example. So you feed liquidity to a pool. You get LP token. You take that LP token and you stake it in some pool. And then you get a governance token. Let's say a Uniswap or an Aave governance token. That token actually fluctuates in value. Okay? So you already did an LP token. Your liquidity is there and it's safe and secure, right? Your principal is guaranteed. You get an LP token back. This LP token you can realize and put it to the lending pool, or you can put it to staking pool, right? And get a governance token. The governance token usually fluctuates in value. So here you're going to have a portfolio approach, because until you sell the governance token, it will fluctuate in value, right? So you have a higher APY because you have a second layer of boosting, not only providing liquidity, but also using the second layer of the product to maximize it. But you are exposed to the value of the token that you hold, right? You're not your principal, only earn, right? So we're working towards that product right now, how to show it to the client and how to properly position it with the client, and what kind of products cross-chain we can use. Because again, we have a cross-chain execution and cross-chain data. So we can use one product from Compound and then use the other product from Aave and third product from Uniswap to maximize it. So we want to analyze right now the approach, but it's going to be more of the mutual fund portfolio approach. While the current product that's on the market and people are using it, it's more of the like a fixed income or interest account, or we'll go with high yield. So every day you get dollars that you can withdraw at any time because all the assets are there. I mean, we obviously check the balances every day. There's a certain procedure of reconciliation and rebalancing. So that's a completely different approach. So fixed income and portfolio. Right, so portfolio we're working on, and it's going to come to market soon. This is in terms of the financial engineering. But if you look at the features right now, we have ACH already embedded. We have Plaid. You can fund it with Wire, and we're going to introduce debit card really soon in about a couple of weeks. And the mobile application is coming to market in about a month.
Very cool. And yeah, it's great to have that onboarding through Fiat as well. I think that's going to really help. I am looking forward to checking out the portfolio part as you continue to expand in the DeFi space. And we don't have a lot of time left, Max, but for the people that are interested in learning more about the fixed income, the stablecoin yields, the upcoming portfolio integrations that are coming, what's the best way for them to get involved with CoinChange and learn about the community as well?
I would say, first of all, go to the website, coinchange.io. Secondly, you can just find us on Telegram. We have a group there, 2,000 people right now. Everybody's pretty active, and you can read, and there's a lot of information shared. We host right now weekly updates on the product and for the community as well. So sign up for the newsletter on the site, and follow me on Twitter. Find me there as Max Galash.
Sounds great, Max. I will leave all those links in the description box below as well. All the best on CoinChange moving forward. And let's follow up in the near future.
Thanks a lot.